A self-employed American can gross $150,000 a year and still get denied a mortgage by banks in the United States. Not because of bad credit, not because of missed payments, not because they can't afford the house, but because of a trap hidden inside the exact tax strategy their accountant told them to use. And the strange part, most accountants in the United States are giving the correct advice, but that same advice can quietly destroy your chances of getting approved for a mortgage. If you're self-employed in the US, what you're about to hear explains why the system that rewards you for building a business can be the same system that blocks you from buying a home. Stay with this, because once you see the mechanism, you cannot unsee it. Here's the moment many entrepreneurs recognize. You've worked for years. You built something real. Your income is higher than most people around you. You walk into a bank confident. You hand over your documents. At first, everything feels normal. Then the loan officer starts reviewing your tax returns. Their tone changes. Their body language changes. And a few days later, you get a message that doesn't match the reality of your income. The mortgage was denied. This isn't bad luck. It's math. And the math was never explained to you. To understand what's happening, you need to see two separate systems operating inside the American economy. They run side by side, but they don't communicate with each other. System number one is the IRS tax code. System number two is the mortgage lending framework used by American banks. The IRS tax code encourages business activity. It rewards entrepreneurs for spending money to operate their business. Deduct your home office. Deduct your vehicle. Deduct your equipment. Deduct your software. Deduct travel. Deduct professional services. Every deduction lowers the income the IRS agrees to tax. This is legal. It's intentional. And it's exactly what accountants advise self-employed clients across the United States to do. From a tax perspective, this strategy works perfectly, but then the second system enters the picture. When you apply for a mortgage in the United States, the bank does not start with your gross income. They start with the income shown on your tax return. Specifically, lenders typically analyze the net income reported on forms like Schedule C or Schedule K1, and they usually review the last 2 years. Here's where the math begins to change. Imagine a consultant running a successful small business. In the last year, the business generated $150,000. That's the money clients paid. That's the money that hit the business account. But after legitimate deductions, software subscriptions, mileage, contractor payments, equipment depreciation, insurance, professional development, the taxable income drops. Now the tax return shows $80,000. From the IRS perspective, that's completely normal. But the bank doesn't see the $150,000 your clients paid you. The bank sees $80,000. And if the year before showed $55,000, the lender averages those two numbers. Suddenly, your qualifying income becomes $67,500. You walked into the bank earning $150,000. The bank believes you earn $67,500. And the entire lending decision now runs on that number. This is where debt-to-income ratios enter the equation. In the United States, most conventional loans use a debt-to-income threshold somewhere around 43%. That number determines how much monthly debt a borrower can carry relative to their documented income. Lower income on paper means lower borrowing power. So the house you thought you could afford based on your real earnings suddenly becomes impossible based on the income the bank recognizes. Denial. If this is connecting with something you've experienced, take a second to hit like and subscribe. This channel breaks down the financial mechanics most people only discover after the bank says no. These financial mechanics are rarely explained clearly, and more people need to understand how the system actually works. Now here's the deeper contradiction. The tax system rewards you for lowering your income. The lending system rewards you for increasing it. Same person, same business, same money. Two completely opposite interpretations. This creates a strange psychological moment for entrepreneurs. For years, you're told, reduce taxable income, maximize deductions, lower your tax bill. Then the day comes when you want to buy a home. Suddenly, lenders want to see higher income on paper. And for many self-employed Americans, that realization arrives too late. There's a story a mortgage broker once shared that illustrates this perfectly. A landscaping company owner in Florida built a strong local business. That year, his company generated around $180,000 in revenue. His accountant helped him apply standard deductions: equipment, fuel, vehicle depreciation, crew payments, insurance. By the time everything was calculated, the tax return showed about $72,000 in net income, perfectly legitimate. But when he applied for a mortgage, the bank used that $72,000 number to calculate what he could afford, not the $180,000 his business produced. The result? He qualified for less than half the home price he expected. This moment shocks a lot of entrepreneurs because psychologically, they believe their business success should determine their borrowing power. But banks aren't measuring entrepreneurial momentum. They're measuring income stability and documented risk. If you're self-employed in the United States, a contractor, consultant, freelancer, or small business owner, this is one of the most important financial mechanics you can understand. Because once you know how the system evaluates income, the strategy becomes clearer. Not easier, but clearer. First, timing matters. Mortgage lenders usually analyze 2 full years of tax returns, which means financial decisions made today can affect borrowing power years from now. Second, understand the trade-off between tax minimization and lending qualification. Lower taxable income reduces taxes, but it can also reduce the income lenders recognize. Third, maintain consistent financial documentation. Banks are not just evaluating how much money you make, they're evaluating how predictable that income appears over time. And finally, understand the deeper structural truth behind this situation. The American tax code quietly encourages entrepreneurs to look poorer on paper, but the American lending system rewards borrowers who look richer on paper. 2 systems, 1 number, completely opposite incentives. And millions of self-employed Americans find themselves stuck right between those 2 interpretations, which raises a bigger question worth thinking about. The American financial system, its tax structure, its lending frameworks, its credit models was largely designed during a period when the dominant income model was a +2 paycheck from a single employer. But today the economy looks different. Freelancers, consultants, independent contractors, small business owners operating at scale. Income flows differently now, yet the mortgage system still treats a W-2 paycheck as the default signal of financial stability. And that leads to a realization many entrepreneurs eventually reach. The financial system in America was largely built for employees, not entrepreneurs. Whether that changes in the future is another conversation. But once you understand the gap between these 2 systems, you can start making financial decisions with both sets of rules clearly in view. And once you see that gap, you start noticing it everywhere.